the ultimate guide to investing in ETFs for beginners. Investing in the stock market can be intimidating for beginners. With countless investment options, from individual stocks to mutual funds, navigating the landscape can quickly become overwhelming. However, there is a middle ground between individual stock picking and mutual fund investing that combines the best of both worlds. Exchange-traded funds, ETFs, have emerged as a popular choice for investors looking for diversification, lower costs, and flexibility. If you're a beginner considering ETF investments, this guide will walk you through everything you need to know, from the basics to advanced strategies. What are ETFs? An exchange-traded fund, ETF, is a type of investment fund that holds a collection of assets, such as stocks, bonds, or commodities, and is traded on an exchange much like a stock. ETFs provide a way for investors to buy a broad portfolio of assets with a single purchase, allowing them to diversify their investments easily. They are structured to track the performance of an index, sector, or theme, making it easier for investors to gain exposure to various markets or industries. One of the key features of ETFs is their ability to be traded throughout the day on the stock exchange, unlike mutual funds, which can only be bought or sold at the end of the trading day. This provides investors with more flexibility and liquidity in managing their investments. How do ETFs work? ETFs are structured as open-end funds, which means they continuously issue new shares or redeem existing ones. They are typically passively managed, meaning they track an index or benchmark rather than being actively managed by a portfolio manager. For example, an ETF tracking the S&P 500 would hold the same stocks in the same proportions as the index itself. ETFs are created through a process known as creation and redemption. Large institutional investors, such as market makers or authorized participants, can create new ETF shares by depositing the underlying securities into the fund. Alternatively, they can redeem ETF shares by withdrawing the underlying assets. This process ensures that the ETF's price remains close to the net asset value, NAV, of the underlying assets. One of the reasons ETFs have become so popular is their liquidity. Since they are traded on stock exchanges, they can be bought and sold at market prices during trading hours, just like individual stocks. This makes it easy for investors to enter or exit positions quickly without the limitations of mutual funds. Why invest in ETFs? ETFs offer a range of benefits that make them an attractive option for both beginner and experienced investors. Some of the key advantages include diversification. One of the biggest advantages of investing in ETFs is diversification. Instead of purchasing individual stocks, which can expose you to the risk of a single company, an ETF allows you to invest in a broad basket of assets. For example, an ETF that tracks the S&P 500 index gives you exposure to 500 of the largest publicly traded companies in the U.S., spreading your risk across various sectors. Lower costs. ETFs generally have lower expense ratios than mutual funds because they are typically passively managed. While actively managed mutual funds require a portfolio manager to select stocks, ETFs simply track an index or sector, which means lower management fees. This cost advantage can make a significant difference in long-term returns, especially for beginner investors looking to minimize fees. Liquidity. ETFs can be traded throughout the day on stock exchanges, offering flexibility for investors. This is a major benefit for those who want to react quickly to market movements or need to adjust their positions during the day. Transparency. Most ETFs publish their holdings on a daily basis, allowing investors to know exactly what assets they own. This level of transparency is helpful for beginners who want to understand where their money is being invested. Tax efficiency. ETFs are generally more tax efficient than mutual funds. This is because ETFs are structured in such a way that capital gains taxes are minimized. When an investor sells ETF shares, they are typically taxed only on the capital gains from that sale, while mutual funds may distribute capital gains to investors, triggering additional tax liabilities. Access to different markets and sectors. ETFs provide easy access to a wide range of asset classes, including stocks, bonds, commodities, and international markets. For example, if you want to invest in emerging markets or specific industries like technology or healthcare, there are ETFs tailored to these sectors, giving you targeted exposure. Types of ETFs. ETFs come in various forms, each designed to serve different investment goals. As a beginner, it's important to understand the different types of ETFs so you can make an informed decision about which ones are right for you. Stock ETFs. These are the most common type of ETF and track the performance of an index, such as the S&P 500 or the Dow Jones Industrial Average. Stock ETFs offer broad exposure to the stock market and are ideal for investors seeking long-term growth. Bond ETFs. Bond ETFs invest in a portfolio of bonds and are generally used by investors looking for more stable income streams with lower risk than stocks. Bond ETFs can focus on government bonds, corporate bonds, or municipal bonds, providing diversified exposure to fixed income securities. Sector and industry ETFs. These ETFs focus on specific sectors or industries, such as technology, healthcare, or energy. Sector ETFs can be a good choice for investors who want to concentrate their investments in a particular area of the economy that they believe will outperform others. International ETFs. These ETFs focus on foreign markets and provide exposure to international stocks, bonds, or commodities. International ETFs can help diversify your portfolio by offering exposure to economies outside your home country. Commodity ETFs. Commodity ETFs invest in physical commodities, such as gold, oil, or agricultural products. These ETFs can serve as a hedge against inflation or economic downturns, as commodities often perform well during periods of market volatility. Thematic ETFs. Thematic ETFs focus on specific investment themes such as clean energy, artificial intelligence, or cryptocurrency. These ETFs allow investors to gain exposure to emerging trends and industries that could offer significant growth opportunities. Dividend ETFs. Dividend ETFs focus on companies that pay high dividends. These ETFs are ideal for income-seeking investors who want to receive regular payouts in addition to potential price appreciation. Inversed and leveraged ETFs. These are specialized ETFs designed to provide greater returns by using financial derivatives and leverage. While they offer the potential for higher gains, they also come with increased risk and are not recommended for beginners. How to buy and sell ETFs. Buying and selling ETFs is relatively straightforward, especially if you have experience purchasing individual stocks. The process begins with selecting a brokerage account. Most online brokers, such as Vanguard, Fidelity, Schwab, and Robinhood, offer access to ETFs. Here's a simple step-by-step guide to buying and selling ETFs. Choose a broker. Open a brokerage account with a firm that offers access to a wide range of ETFs. Consider factors such as trading commissions, account fees, and research tools. Select your ETF. Research ETFs based on your investment goals, risk tolerance, and desired exposure. You can use tools like Morningstar or the ETF screener on your brokerage platform to filter ETFs by asset class, sector, performance, and more. Place your order. Once you selected an ETF, you can place a market order, which buys the ETF at the current price, or a limit order, which specifies a price at which you're willing to buy. Monitor your investments. After purchasing an ETF, it's important to regularly monitor its performance. ETFs are traded throughout the day, so you can track your investment in real time. However, keep in mind that long-term investments should be assessed with a focus on the bigger picture rather than short-term price fluctuations. Selling ETFs. When you're ready to sell, you can place a sell order with your broker. You can sell ETFs at any time during market hours, just like individual stocks. Also, if you want to dive deeper into ETF investing, we've included links to some useful tools and insightful books in the description below. You can check them out and purchase them directly from there to enhance your investment knowledge and make smarter decisions. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.